In this lesson, I'm going to show you a price action methodology that I use to gauge whether the market is going to rise or it's going to fall. And I am going to include in this supply and demand. As you guys know, supply and demand forces is what moves the market. Understanding supply and demand can be a key for you guys to see yourself becoming a more profitable trader, or to see yourself getting entries at really, really good areas of value for you to get good risk to reward ratios. Okay, guys, I don't want to waste any longer. Let me take you onto the charts, and I'm going to show you a concept on how the market moves from supply to demand and from demand to supply. I hope these guys will help you understand how you can do your technical analysis much better. So without wasting any time, if you're new to this channel, do give a like, subscribe, and also comment down below with your questions, guys. So let's go on to the lesson, and I'm going to show you guys how you can see price action the way it really is. Let's go on to the charts now. So guys, price action basically is represented on a technical price chart by the candles. Bullish and bearish candlesticks represent the price action between buyers and sellers. Now, many traders don't understand what that really means, okay? But I want to show you guys what that really means on the technical chart, and I hope you guys will be able to understand this. Next time when you look at your chart, you will know exactly what is happening on the price chart. Now, we are here on the GBP card chart. We are on the GBP card chart, okay? It's a 1 hour chart. Now you can see here we have red candles, we have green candles. But these red and green candles are not just colors, okay? This could be black and white candles. What you have to understand is that the green candles represent bullish momentum, and bearish candles are represented by the color red in this case on the charts, okay? But you can color these candles in any way that you want. They can all represent the same thing. Now, why does market sometimes move from demand to supply, from supply to demand? For example, you see that this area here, this was a demand zone right here, okay? This was a demand zone. Why does price move from this demand zone to a supply here? Why does it move to this supply up here? This area here is an area of supply. Why does it move up and down like that? So I want to explain to you guys that on a plain chart. I'm just going to illustrate for you guys what that means and how price actually moves from demand to supply and from supply to demand. I hope you guys will be able to take notes, ask questions where you don't understand, and also comment down below, guys, with whatever you have in mind, okay? So let me assume, or let us all assume, that we all know that price moves in either a trending market, bullish or bearish, and then it consolidates, okay? Most of the time the market is consolidating, but it also does move in trends, which is a bullish trend or a bearish trend. Now, when you come into the market and look at the technical chart, you're always looking at the market making highs, higher lows, higher highs, higher lows, higher highs, okay? That is if it is moving in a bullish trend. Or you can find the market simply caught up in something like this: equal highs, equal lows, equal highs, equal lows, equal highs, equal lows, okay? Something like this, okay? Or you can find the market creating a low, lower high, lower low, lower high, lower low. These are the three market phases that we have within the FX market and also the stock market, or any tradable market that is represented on a technical price chart. Now, what you're looking at here is market structure. These trends or consolidations are creating what we call market structure. Now, market structure is a container where you find your demand and supply zones, or your support and resistance zones, okay? So I'm going to show you here what supply is and what demand is, and why these happen, or why these occur within the market. We all know that in the market, there is always a seller and there is always a buyer. Okay, so the sellers always want to sell at supply prices, and the buyers want to sell or want to buy at the prices that they demand. They want to buy at lower prices, while the sellers always want to sell at a higher price. So supply is a price level, a pricing level that sellers are willing to sell from, and demand is a pricing level where buyers are willing to buy. So we are going to look at how this happens. Okay, for example, let's use an example of say the price of bread. Okay, price of bread. You go to the shop, you find, okay, the price of bread is rising. When the price of bread is rising, why is the price of the bread rising? The price of bread is rising, or price of anything you want to name within the market rises simply because there is a lot of demand for it, and yet there is scarcity. Okay, there is less supply for it, but the demand is higher. So you'll find that the price will continue rising because there is demand within the market. Now, at some point, the price of the bread will come down. Okay, it will come down, and then it will come below some of these higher lows. Okay, it will come below there. Okay, and then once it comes below here, you know that the sellers have seen that this area here was the last area that they sold the bread at its lowest price here. Okay, so when the price breaks below this level here, when the price breaks below this level, most of the sellers will stop selling their bread until the price comes back up close to the price where they sold it at the highest price for better profit. When the price comes there, the sellers will step in and start selling off their remaining stock. So this is an example of a demand structure within the market. I hope you guys are understanding this. Let me just go through it once again. When the price of an underlying asset, for example, bread, oil, whatever, is rising, okay, at some point it will reach where the buyers feel like the price is very, very expensive. Okay, it is very expensive for them to continue buying. At that point, the price or the demand for that specific item, in this case the bread, drops. Okay, the demand drops, and when demand drops, it causes surplus within the market. You guys know this from economics. It causes surplus in the market, and when there is surplus, the price of that item will drop. Okay, so the price of the item drops here. Once it comes below previous demanded price where the buyers were still willing to buy from, once it comes below that price, it becomes very cheap for the sellers to continue selling it. So the sellers will stop selling their remaining stock to wait for the price to go back up so that they can get a better profit margin. And at the same time, because it has dropped below the price where the buyers were willing to buy from, the buyers feel like this price is cheap enough for them to get into buyers again. So that will push the demand of this item a bit higher, back to an area now which becomes an area of supply where there was a surplus. Okay, this becomes a supply zone where the sellers will be willing to sell off again. This is why the market moves the way you see it moving. This is why the candles are printing the way you're seeing them printing on a technical chart like this one here, guys. This is why this is happening. This is happening because of this illustration I have given you guys right here. Okay, this is for supply. The opposite is true for demand. When the price of an item is becoming cheaper and cheaper and cheaper and cheaper and cheaper, it will reach a point where it becomes so cheap that the buyers will be willing to buy at that point. Okay, they'll be willing to step in at that point. But the sellers at the same time are no longer willing to sell so much at that level because it is way cheaper than they should be selling for better profit. So what happens is that the price will move up because the supply of that item will be very low because the sellers are no longer willing to sell at that price, so they keep their stock. So the supply of that specific item within the market drops, and when supply drops, you know that the prices of that specific item start to rise because there will be more demand than supply in the market. So what happens is that price will start rising, and when the buyers see, okay, that the price has reached this previous high price, okay, they stop buying from there. Once the price exceeds this previous higher price, the buyers will stop buying from there, okay. So they will wait for the price to come back below this to get it at a cheaper price, okay. So when price comes back near the price where the buyers were stepping in to buy, just near it, the buyers will step in and sell and buy off the remaining stock from the sellers who are willing to sell here, okay. They will buy it off, and then they will continue driving the price up. So this becomes a supply zone, I mean a demand zone, guys. Pardon me, demand zone. This becomes an area of demand, okay. So this is the principle that drives the market, okay. This, what I'm showing you here, is the principle that drives the market. If you understand how the market moves based on the supply and demand, just like any other market, this will really make you a more profitable trader, because you will be able to take decisions within the market with a very, very informed mindset, okay? You will come into the market well informed on how this is happening. That is why I always tell you guys, and including my students, I always tell them to not only look at the technical price chart. You have to look at the fundamentals, look at the news, what is happening in the real market, okay? What is the sentiment of the market? What is the sentiment of consumers, okay? Look at the fundamentals before you come onto the technical price chart. The technical price chart is used for timing your entries, while the fundamentals allow you to gauge market direction, looking at the forces of demand and supply within the market. So, guys, this is what I wanted to show you, and I want you guys to go and try to put this into practice, understand how the market moves in this pattern here. This pattern here is the key pattern that drives the market. Once you understand this pattern, there is nothing else that can stand between you and profitability. Hope you guys are seeing this. And let me just show you this on a real technical chart. I'll show you examples on a technical price chart so that you can see why price is moving the way it is moving. I'll just show you guys here, okay? All right. So you see that price was going up here, okay? It was going up here, it stopped here, and then it dropped, okay? It dropped below this area here, okay? Let me just remove this first. Let me use something more clear for you guys to be able to see. Price was moving up, down, up, down, up, okay? Then it is sold off here, okay? Sold off here and broke below this previous price, okay? Just as I demonstrated to you earlier on, came and broke below here. And when it broke below that area, okay, the sellers saw that the price has become cheap, so they cannot continue selling at a very low price here. They have to go back up to pick up orders, okay, to pick up the stock that was remaining up here. So they go back up, pick up that stock, and then sell off, okay? So where is the demand? I mean, where is the supply? The supply is this candle here, okay? Okay, you can see that green candle, that is your supply zone. Okay, I want you guys to go and try to practice identifying these levels on the technical price chart. I know that when you do this for some time, it will become like second nature to you, and you'll be able to actually take better trades and take more informed decisions, guys. So yeah, let's try to look for like the area of demand. Okay, an area of demand. Now here we had this high here. Okay, price was going down, then it reversed and went up, okay, above this high. Then it priced back down to pick more orders around this area here where it first moved away from. So this area here, this area becomes an area of demand, guys. This becomes a demand area. Let me show it to you clearly, okay? You see, this area becomes an area of demand. You see the candle comes back, picks up these orders, and look at how big this candle moves away from this area. Okay, this area becomes an area of demand. Okay, so I want you to go and try to practice finding these areas on your technical price chart. Okay, you can even see here also price comes down here below this low, here stops, goes back to pick up more orders, and look at how aggressively it sells off. Okay, so you can say that this area here becomes your supply. Okay, that area becomes your supply once the price has pulled back into it. But remember, you have to wait for price to first break previous lows. Okay, like here, price breaks a previous low like this. Let me show you. Okay, this is the previous low which was broken before price went back to supply and then picked up more orders and sold off. Guys, this is a principle of market movement. Okay, market moves from supply to demand and from demand to supply. Okay, that is how the market moves. It is not moved by the candles or the candlestick patterns or the chart patterns that you see on the technical chart. The technical chart is just for timing, but the true market movement is influenced by the fundamentals, news events, interest rate decisions, and other things that are found within the technical side of the forex market and the analysis that you can do over there. So guys, I hope you guys have understood this. Hope you'll apply the knowledge. Have any questions, drop them in the comment section down below. I'll be able to come back and answer you guys. Until next time, peace and out.